You're not going to believe what I just did. I sold almost 30% of our Tfsa dividend stock portfolio in a bear market. This will be one epic portfolio update. Let's do this. I really don't want to do this. So why in the world did we sell 30% of our Tfsa portfolio at the absolute worst time to sell basically anything? In short, we had to. We had a family emergency and needed to come up with $50K ASAP, with only two options: paying 6% and rising on a HELOC, or divesting some of our assets. So after the back and forth for a week, we divested a huge amount from our Tfsa in a matter of a couple of days. In this update, we'll go through each holding, its new weighting compared to the old, and how much was sold at what price. You have to stay to the end of this update to see the totals of everything we sold. We'll also be sharing the 3 lessons we learned in the process, even after 18 years of investing. So how are we going to move forward from this? Well, the plan is to start to rebuild the portfolio in the new year, when we get back our contribution room. So make sure to hit that subscribe button so you don't miss out on our future updates. You can also see what we're investing in and follow our trades live on our new Blossom social account. You can download Blossom for free and earn $5 on sign up when you use the code Mr. Financial. My wife will post the details below. See you there. Let's start, as always, with our one and only ETF in our Tfsa portfolio, VFV, Vanguard's non-hedged S&P 500 index ETF. Despite the plummeting in price in September, we sold 10.19 shares at a price of $89.51. Right now, it makes up just 0.2% of our portfolio, down from 0.7%. This was one of the small losses we had in the sell-off. The reason is we had been building this position during the elevated market. Hopefully the market stays down as we try to build this position back up. Next was our second largest holding, Power Corporation of Canada, at 8% of our portfolio. We completely divested even after owning it for so many years. This was a loss on book value, but many of our shares were drips, so we were still up on the total return quite a bit despite the price pulling back 25% this year. Our reasoning for divesting was that this is a position that we believe will have a longer road to recovery compared to some, since it is a holding company in a tough equity market. This was also a portfolio redundancy as we also owned GWO. We sold all 392 shares at an average price of $32.37. Ouch! It hurts to even say that. I remember those prices back in 2014. We'll decide in the new year whether to bring this holding back into the fold. Next up, we have our mid-cap utility, Capital Power Corp, at 8.3% of our portfolio. This is up from 7.9%. As our best performing stock of the year, I hated giving this a haircut. We sold 58 shares at an average price of $50.61. That was only 2% off of its all-time high. By fluke, it is now down almost 20% as we record this. Hopefully the share price stays depressed despite being a rather defensive holding. Next up, we have First National Financial at 8.2% of our portfolio. This is up from a previous 7.4% despite divesting 90 shares at an average price of $36.73. We would have divested more from this position if the share price hadn't dropped 5% just when we made the decision to divest. This continues to drop in value, so hopefully I'll be DCAing back at less than I sold for. Next up, at 9.4% of our portfolio, is Bank of Nova Scotia, up big from the previous 6.9%. This is now our second largest holding, though I wish it was TD. We sold 5.1456 shares at an average price of $68.56. The price has continued to drop. This wasn't something I wanted to trim at these price levels, but we had to come up with the money. With earnings coming out early November, I expect this to recover a little, as these prices I haven't seen since 2014, 2015, like with POW. Hopefully we can drip these shares back at these levels. Next, we have TC Energy Corp at 7.9% of our portfolio, up from 6.4%. This has now become our fifth largest holding. We have owned them forever and divested as little as we could, selling 19 shares at an average price of $59.19. This was trading 8% higher at the beginning of the month. The market jitters are really hitting the energy sector more and more now. This will remain a core holding for us. Next up, we have BCE Inc. at 5.5% of our portfolio, down from 6.4% of our portfolio. This also remains a core holding of our turf model. We trimmed this to match our TELUS weighting, though I wish it was the other way around and we were able to buy more TELUS to match our BCE weighting. We sold 73 shares at an average price of $62.01. Telecoms, like most of the market, have continued to pull back in price. Next up is ALGONQUIN Power and Utilities Corp, which is our renewable energy play. It now makes up 5.6% of our portfolio, almost unchanged from the 5.7% it was. We sold 110 shares, or about 20%, at an average price of $16.98. This stock got hammered with the rise in cost of borrowing. At one point, it crossed below the $14 mark before I recorded this. I still have full confidence in my thesis for this company despite the market sentiment. I hope to buy it back at this lower valuation in the new year. Next, we have Enbridge at 6.9% of our portfolio, up from 5.5%. The stock price continues to fall, and it even got close to the price I'd consider buying again. Our current target price is $48. We trimmed 10% of our shares, 19 to be exact, at a price of $54.20. We want to add to this position. However, with the smaller portfolio size, I need to be careful with our energy weighting. Next, we have another midstream pipeline, PEMBINA Pipeline Corp. It was 5.2% of our portfolio and now represents 6.6%. It is crazy to think that not long ago in June, it was flirting with its all-time high. We sold 10% of this holding as well, 18 shares at a price of $42.68. Next up, we have SmartCentres Real Estate Investment Trust at 7.1% of our portfolio, way up from the previous 4.9%. This REIT is another staple in our turf portfolio. We didn't trim any of our shares as it was too underweight for my liking compared to RIOCAN. We hope to add to this position with its amazingly low share price I haven't seen in years. We still consider it to be one of the top 4 REITs in Canada, along with RIOCAN, Granite, and Canadian apartment properties. Next is our last utility, Fortis. We sold 21 shares at $56.13. It now represents 5.5% of our portfolio, up from 4.7%. This is one of our original purchases in our Tfsa. It is a steady eddy, and yet it has dropped just like all the other utilities as interest rates rise, just not quite as much as ALGONQUIN. At one point, it was trading in the 2019 range. Hopefully, we can buy some of those shares back at these current levels. Next, we had Great-West Lifeco at 4.1% of our portfolio as a solid large cap. And yet, we gave it the buzz cut, completely selling 227.075 shares at an average price of $30.38. Yucky. It is crazy to think that this was trading at all-time highs in February. GWO had been a staple of our portfolio and had been growing our dividends for a long time, post-financial crisis. This was a position we were debating divesting earlier because of the 70% redundancy with POW, and this seemed like the time to do it. Next is MANULIFE Financial Corporation at 4.4% of our portfolio, up from 3.8% despite selling off 74 shares at an average price of $21.83. This is now our sole stock in the insurance industry. We were wanting to increase our position, so this worked out well. I'm hoping to buy back some of those shares in short order because MFC does not normally trade in the 5 to 6 PE range. Next up is TELUS Corporation at 4.8% of our portfolio, up from the previous 3.7% at the end of August. This is despite divesting 23 shares at an average price of $28.84. We divested a lot less TELUS compared to BCE as we're trying to bring them closer to equal weighting. Plus, I just like TELUS as a stock. It's never let us down, yet. Next up is our dud, a small cap asset management company, FIERA Capital. It represents 4.2% of our portfolio, up from 3.5% of our portfolio. They have been on the chopping block before, but keep dangling the carrot with good quarterlies every now and then. We divested 127 shares at an average price of $8.80. This has been our most underperforming stock in our portfolio. Next, CANOE EIT Income Fund is making up 2.5% of our portfolio, up from 1.8%. This is one of only 2 positions we did not divest from. I still see this income fund performing well despite the crazy market, with it holding so many high-quality blue-chip stocks. Next, we have Canadian National Railway at 0% of our portfolio. This was a small position previously at just 1.6%, though we had been wanting to increase its size. Having to come up with so much cash, this made it easy emotionally to sell this off completely. We sold 18.09 shares at an average price of $151.49. This is a reminder for me to continually add to my positions on pullbacks, as this used to make up 3% of our portfolio when it was smaller in size. This stock is poised to run with earnings coming out next month and the inflationary conditions boding well for rails and other transportation stocks. Next, our favorite bank, our pump stock, not our dump stock, Toronto Dominion, and we dumped it. This went from a large holding in February to a 1.1% weighting, and for similar reasons to CNR, we just divested completely. It's going to hurt to build this position in the coming months, but c'est la vie. We sold 20.33 shares at an average price of $83.97. Yikes. Next is our last bank, Canadian Imperial Bank of Commerce, 0% of our portfolio. We sold this off as well, 25 shares at $60.52. Just like TD, it went from a sizable holding to 0.9% of our portfolio, and now, zilch. It really is easier to sell off a holding when we hold so few shares. It is really undervalued right now and still remains the smallest of the big five by a large margin. We're still undecided if we're going to reintroduce it into our TFSA. Next is what used to be our smallest holding at 0.6% of our portfolio, GOEASY Ltd. We divested the small position we had built up. This is one of two with a loss on the total return. We started this position in March 2022, making it easy to take the loss. I can see the potential for this small cap and would want to bring it back into the fold as a replacement for FIERA. We sold 7.38 shares for an average price of $106.92. Ay chihuahua caramba, close to its 52-week low. Lastly, our largest holding is still RIOCAN Real Estate Investment Trust at a whopping 12% of our portfolio, up from 9.3%. This position became number one during the 2020 crash, and now with the sell-off in the market really affecting Canadian REITs, we only trimmed it ever so lightly. We sold 40 shares at an average price of $18.36. So there you have it, all 22 of our holdings and what was sold. We now have only 16 holdings in our TFSA with plans to rebuild positions in 3 of them for sure. In total, we withdrew $49,420.08 from our TFSA from the stocks we sold and a little of the dividends received from September. For the remainder of the year, we'll be using our dividends to build up some of our positions. Come the new year, we will push hard to max out our TFSA again. The end of September just sucked. We hate divesting. But that's how life is. We got to just roll with the punches. And if anything, this is just another opportunity to learn and improve for the future. So here are a few lessons we learned and relearned. Know the tax implications of divesting. They are huge. We were contemplating the whole non-registered versus TFSA or RRSP divestment strategy. In the end, we had to sell much less in our TFSA to come up with the correct dollar amount after accounting for taxes. For example, with capital gains, we'd have had to sell $63,000 worth of stocks or 26% more to come up with the same figure. This reiterates in our mind the beautiful tax advantages of the TFSA. 2. Have an exit plan. Even with a substantial contingency or emergency fund, we should have had an exit plan. I was reminded that the best of plans may need to change. Additionally, it's a lot easier to change course in calm waters than during a storm. And 3, all is not lost if you ever have to sell from a TFSA. This is the second time we had to divest some of our stocks from our TFSA. It hurts for sure. We just reminded ourselves that come January, we can recontribute the $50,000. Thank you so much for watching this rather depressing update and helping the channel out with your likes and comments. Until next time, I'm Mr. Financial.